The AI rally continues to power global equities higher, but the foundations beneath it are becoming increasingly questioned. On one hand, chipmakers keep surging on expectations of relentless AI investment, but on the other hand, the very companies financing that boom are starting to lose investors' confidence, raising a very uncomfortable question. Can AI enablers keep climbing if hyperscalers eventually slow their spending? So welcome to Swissquote's Daily Market Talk. It's Tuesday, 13th of June. I'm İpek Özkardeşkaya, and in today's episode we will talk about technology, energy, global macro, FX, and gold. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So today is the last day of the month and the last day of this quarter, the best quarter of the past 6 years for the global equities according to Bloomberg, ladies and gentlemen, and that despite the Iran war, disrupted oil and fertilizer flows, a spike in energy prices that led to a spike in global inflation expectations, which in some parts of the world led to interest rate hikes already and in others to hawkish monetary policies. Regardless, global equities were boosted by AI build-out. Of course, the indices that have little exposure to technology were left behind, and the pretty narrow market breadth is raising a few eyebrows. But the rally continues despite an eye-watering volatility, especially for the Korean Kospi Index, and quite unusually high valuations, especially for chip makers. The Korean Kospi Index was a bit down yesterday before the announcement of massive investment in new chip fabs, is up by 2.40% today. The Nikkei in Japan is slightly in the positive as well, while US stock markets that started the week on strong footage are looking bullish this morning, judging by the rising S&P and Nasdaq futures at the time I'm talking here this morning. But note that not all technology stocks are performing well. The AI enablers, including chip makers, which are the beneficiaries of massive AI spending, are outperforming, while big technology, so the ones that are spending on AI infrastructure, are sputtering. The Magnificent Seven is down by nearly 15%, for example, since the May peak, with Microsoft losing more than a third of its value since October last year. The AI and software giant is being pressured on both ends. On one hand, its massive AI spending displeases investors, and on the other hand, its software business is seen pressured by AI. Now, Microsoft still got its cloud segment, Azure, that should continue to grow along with AI adoption in theory, but investors are jumping out today. Another stellar AI play, Google. Remember, Google is down by 17% since its May peak as well, and that despite its Gemini model, which is quite appreciated, and despite its TPU chips, which are very good for inference, and despite its data center business, Google Cloud. Google has everything to benefit from AI adoption on paper, but a lot is being pressured today by investors' reluctance on extra spending. Meta, on the other hand, is down by nearly 30% since last August because it just doesn't have a leading AI model nor a clear plan other than overloading its social media platforms with AI-generated content. While Amazon is also down by nearly 19% since its May peak. It also spends massively on its AI infrastructure, data center, and chips. Do you see where I'm coming? The massive AI spending from these so-called hyperscalers has allowed companies like Nvidia, Micron, Samsung, SK Hynix, and the likes to print mind-blowing rallies over the past months. But investors are seemingly no longer happy with this spending. They are pulling their money back. And the hole could eventually be filled in by other companies, of course, from other sectors, as many sectors today do see productivity gains and invest in AI, but the problem is their spending could be nowhere near the same speed than the big technologies. I mean, we're talking about 800 billion to up to $1 trillion spending this year alone. Now, good news is hyperscalers still have the bond markets to fuel spending for a little while, but the bad news is eventually if funding becomes difficult and investors not happy, the spending will have to slow down. And if the big technologies' massive AI spending slows, even a little bit, the future revenues as predicted by the market investors for the AI enablers will drop, as will their valuations. And the higher the yields, the bigger the size of potential downside correction. In summary, I'm not very sure today that the chip rally could continue at this speed without the precious support of the big technology. If big technology sneezes, the whole supply chain will eventually catch a cold. But anyway, that's just an unpleasant thought for this sunny June morning. Good news is that the US crude rebounded just slightly yesterday following the weekend tensions in the Middle East and holds near the $70 per barrel level despite another wave of conflicting news. Donald Trump says the peace talks will resume in Doha today, while Iranians say they will not. And the Middle East tensions don't matter for global risk appetite if oil prices remain contained. And for now, they do remain contained, mostly because of the oversupply parts of the oil market as a result of historic strategic reserve releases and also oil tankers sailing through the Strait of Hormuz undercover. But the problem is, the US and Iran peace deal may not be as easily inked. The traffic in the Strait of Hormuz could slow down again, and this time around, the strategic reserves will be alarmingly low to keep investors at peace of mind regarding a prolonged conflict in the Middle East. As such, the $70 per barrel level for the US crude could act as a floor to the latest retreat in oil prices, and upside pressures could flare up again if this week doesn't bring any material progress in US-Iran negotiations, and the latter could keep bond investors on the edge, push yields higher, and apply renewed pressure on global financial markets in the coming quarter. If so, the question would be, who would carry the market higher? I guess we will see, but there is more optimism than pessimism in the market today. So, the US dollar is better bid against most majors and metals this morning. The euro dollar retraced yesterday gains and is pushing below the 114 mark this morning. The sterling dollar is dealing with political uncertainty as Andy Burnham is disclosing his plans about how he would put Britain on its feet again, while keeping fiscal discipline tight. The good news for him is that the gilt markets haven't gone against Burnham just yet. But the bad news is that speaking is rather easier than generating faster growth in an economy that has become increasingly dependent on government spending. I would say that Burnham's cabinet picks could reverse the early confidence in gilt markets quite rapidly when investors come to realize that the path to growth in the United Kingdom and improves productivity with little spending without too much help from the government will be tough. In Japan, the dollar-yen spiked past the 162 level as everybody is holding his or her breath to see when the Japanese officials will intervene, if they do. The likely reason why they are not intervening today is the slow pace of depreciation of the yen against the US dollar and the US dollar's global dominance. Indeed, today the yen is being sold quite slowly, and that's because the rate differential between the US and Japan remains in favor of the US dollar. That means that intervening today in the FX markets directly will change nothing to the market's direction. It will just cost money. So unless we see aggressive sell-off in the Japanese yen, the Japanese officials are seemingly willing to sit still. And finally, gold is gently clearing the critical $4,000 support this morning to the downside. The yellow metal has now stepped into the medium-term bearish consolidation zone below the $41.15 per ounce level, which is the major 38.2% Fibonacci retracement on October 2023 to January 2026 rally, suggesting that a deeper pullback in yellow metal prices is possible. So the next target for the gold bears stand at $36.80 per ounce level, which is the long-term uptrending base and the 50% retracement. And pulling back to this level doesn't even mean that gold's long-term positive trend will be damaged. For long-term investors, gold remains an interesting asset. Remember, especially, many central banks have sold their gold holdings during the last quarter to counterweight the energy price spike, and they will be replenishing their reserves again. So we know that demand will be there, but we don't know at what price just yet. So this is all for this Tuesday. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.